So this is our first online session, class 3 for September 1st. And in this class, we're going to start the discussion of portfolio management, investing. We'll start off by defining what a portfolio is, and then we'll address the 3 questions you should ask when someone comes to you and says they want to put together a portfolio, an investment portfolio. What are the 3 questions you need to ask them? One's a why question, a what question, and a how question. And then today we'll get into the major asset classes. A lot of the next few classes we'll be getting into the sub-asset classes, but we'll start today with the major asset classes and understanding them. This is a great section of the class in that, and it's really important information to know for your own personal purposes, and you'll need to build a portfolio yourself. You'll have a 401k plan, you'll have a Roth IRA, you'll have other investments, and we'll get into what you should be thinking in order to build a really good portfolio. It's also very powerful interviewing in jobs, because many of y'all will have jobs that will be doing exactly this, and you'll have an advantage in those interview questions. But also a very popular interview question is someone comes to you and they have $100,000 and they're asking what should they do and how would you help them. We are going to answer that question, exactly what you would do with that person to help them. It's essentially a financial planning type of approach to portfolio management. I remember there was a firm that did some interviews on campus, and I knew the people that were interviewing the students, and when they left campus I ran into them and asked how it went, and they said they were just blown away. These were students in this class that were studying for the first exam, so they were ready for that question, and sure enough they asked that question. Someone comes to you with $100,000 and wants to know what to do with it, and the interviewer says at one point she stopped listening in order to find out if she wanted to hire the person or not. She started taking notes for her own personal purposes. So it's a powerful piece of group of information. It's categorized in ways that I think will help you remember it. You don't want to put it in short-term memory. You want to permanently remember this. This is a really core area of finance, and especially the investment world, of how do you build portfolios. So let's start with the definition. And here I'm pulling stuff from the class notes, and the reason I do that is so you don't have 2 or 3 sets of notes. You can take your notes alongside the class notes. So I'm starting on page 3 of the class notes with the definition of an investment portfolio. So the definition of an investment portfolio is it's a collection of assets, and that's a key word. I'll come back to that word. Collection of assets held for a particular future purpose. So why are you saving in a portfolio? Why are you building an investment portfolio? Well, you have some future need that you need to fund, and you need to build to that need. The most popular purpose is retirement. All of us need to be saving for retirement. I'm in retirement, so I'm actually living off of my portfolio that I built over my first 25, 30 years of working. You might be saving for education, maybe for your education, go to graduate school, or maybe for your kids' education. You might be saving for a down payment on a house, maybe 5, 10 years from now, or maybe you're saving to leave an inheritance to your charities and to your kids. So let's talk about that collection of assets. Why did I say assets? So an asset is anything that has a future value. In an investment portfolio, we tend to think of investing type assets. So the obvious ones are stocks and bonds, and we'll definitely be talking about those. Stocks and bonds are assets, but they're also securities. And the reason they are securities is because they're traded on public markets and they're very liquid for the most part. There are other assets that are not securities. Things like real estate, commodities, those are also assets, and they can be an important part of a portfolio. So we'll be broadening this out to assets. We'll talk some assets that's maybe a little esoteric, but we'll mainly stick with the broadest, the most conventional categories of assets and securities. So remember, securities are assets. All securities are assets, not all assets are securities, and we'll be covering both types. So that's an investment portfolio, and that's really key to our first question. The why question is that it's held for a particular future purpose. So before you can build an investment portfolio, you need to start with that very first question of why are you investing? What are you saving for? So why are you investing? What is your primary objective? Why does this portfolio exist? What are you funding? And the key here, I use the word liability. And by liability, I'm talking about something that has a future cash outflow requirement. Retirement's the best way to think about that. So when you retire, you're going to need to fund your living expenses for the rest of your life. That's an outflow that you're building a portfolio for. So you can think about that as a liability. And so if you're building a portfolio to fund a liability, then the most important question to ask then is what are the drivers of that liability? What causes that liability to go up and go down? So let's talk retirement. Retirement, you might be actually thinking about a pension plan. The pension plan is essentially a monthly income that you're going to get, a monthly annuity for the rest of your life. So what is going to influence how much that liability is going to be, either in today's dollars or when you turn 65 or whenever you retire? So the first thing is inflation. If you're going to have a portfolio that's going to be able to pay you $3,000 a month for the rest of your life, you can't just have $3,000 forever and ever and ever for 5, 10, 15, 20 years, because inflation is going to reduce the value of that $3,000. So you need to incorporate inflation, or else you're going to be getting poorer and poorer every year as inflation rises. Secondly, and probably most important, is longevity. Longevity is how long will you live? That's your life expectancy. And you have to plan beyond your life expectancy, because if you make it to your life expectancy, there's a 50% chance you'll make it to your life expectancy, which means 50% of people will live longer than their life expectancy. Half of the people will die before that, half after. So you have a 50% chance of living longer. And today there's people who are living 10, 15, 20 years beyond their life expectancy. So how do you plan for that? And then the last thing, interest rates. Interest rates tell you your discount rate. And so when interest rates fall, you take the present value of that retirement portfolio and put it in today's dollars. And when interest rates fall, because your discount rate's lower, that liability is going to jump. And you'll see a large increase in the liability. So your pension plan or your retirement plan is going to be very sensitive to inflation, how long you're expected to live, and to interest rates. So how does that influence your portfolio? Well, you have these three risks. How can you invest in a way to mitigate those three risks? We're not going to talk about longevity risk, but inflation we'll talk about some, and interest rates definitely we'll talk about some. Longevity risk, I talk about how to mitigate that risk in my life insurance class. The life insurance industry does have products that help you with longevity risk. Social Security itself, it covers longevity risk and inflation, because Social Security pays you a monthly income for the rest of your life. So that covers the longevity. It keeps paying you until you die. And it has a cost of living adjustment. So it also covers inflation. So retirement is one of those programs that addresses retirement risk. But you want to probably save in addition to that, because Social Security will probably not be enough to keep your standard of living. So how do we invest in order to handle these three risks, and invest in a way that we find assets that help mitigate some of these risks? So inflation, interest rates are the two biggest ones we'll talk about. Now, some firms use risk questionnaires to try to understand where to put their clients. And risk questionnaires are really after two things, maybe three things, but two things in particular. The first thing is to try to understand your risk tolerance. That part of risk questionnaires I do not like. And so I'm going to give you some dangerous information here. Be careful how you use this in interview, because there are many people who are adamant that risk questionnaires are extremely important. You can't do a portfolio planning without risk questionnaires. But let me tell you why I do not like them. They usually ask a question in terms of what would you do if you went through a market sell-off like 2008, or in 2020 we saw the stock market drop almost 30%. And if you answer that you would sell all your stocks and get out of the market, they're going to say, wow, you don't have very good risk tolerance. We're going to give you a very conservative portfolio. If you say, well, if market sells off, I'll buy more stocks, I'll actually invest more, then I'll give you a more aggressive portfolio. The problem with that is in years like 2005, 2006, or say 2010 through 2019, when markets are just zooming up really fast, people answer these risk questionnaires very differently than they answer them when they're in the middle of a crisis. So when markets have been going up, people answer the questions very aggressively. Oh yeah, I would reinvest. That wouldn't bother me at all. I know stocks go up and down. And so they answer it very aggressively in strong markets. And then when the markets sell off, they become very conservative and become risk averse. And so essentially what a risk questionnaire does is it gets people to buy high and sell low. When markets are strong, they answer risk questionnaires. They're real aggressive. So the financial planner puts them heavily into stocks right before the stock market's about to sell off. That's a terrible thing to do. And then when the stock market sells off, they do a risk questionnaire. They answer it very conservatively. Their financial planner puts them in a very low allocation to stocks, and so they don't buy many stocks right before the stock market's about to rally and come off of its bottoms. So that's why I do not like that part of risk questionnaires. The second part of risk questionnaires is your horizon, your investment horizon. I actually think that's the most important part of understanding the individual is how long do you have to invest? Are you investing for 30 years from now? Or are you investing for 5 years from now? I think horizon is the one critical input for any portfolio management. Make sure you have horizon in your answer when you're answering this on the exam one. Horizon, I think, is really critical. I remember talking to Barclays Bank. They had a risk questionnaire for a product they were showing us, and I was telling the salesman how much I dislike risk questionnaires. And he said, if you don't tell anyone, I'll give you a secret. So here I'm telling you Barclays' secret. But he said, if you go through this booklet, the booklet was written so you answer the question, and depending on the answer, they would kick you out to a different page. So if you answer this, you go to page 8. If you answer this way, you go to page 3. And he says, it looks like we're customizing this for risk tolerance. We're trying to figure out the individual customer needs. But the bottom line, whatever you answer, it all comes down to horizon. So everybody gets the same answer, and the only difference is your horizon. People who have a longer time to invest, they invest more in stocks. People who have a shorter time to invest, they're going to need their money more quickly. They're invested less in stocks. And we'll talk a little bit more about that when we talk about stocks and bonds. So I told them, yeah, I'm okay with that. That makes sense. And it is true, younger people do buy more in stocks. Older people do tend to buy more in bonds and avoid stocks because they're more risky. My life insurance class, we talk about that. There's a concept called human capital, which drives that. And so, yeah, it's an important concept. We won't cover human capital too much in this class, but it is very much related to that horizon you have to invest. How long will you be investing before you start to need to draw on that portfolio? If you don't know what drives your liabilities, I'm going to argue that you cannot invest successfully. I remember I was at a party and as a USAA group, and I saw a guy I hadn't seen in a while, and I was, hey, it's good to see you again. And he introduced me to his wife, and he told her, yeah, Ron's USA's investment guy. He does all the investments at USA. And so she turns and immediately asks, should I buy gold? That was the first question she asked me. And so, should I buy gold? And well, why are you buying anything? What are you investing for? What's your purpose? Is this for retirement? Are you saving money to go on a trip next week? Are you going to use it to buy groceries today? Are you going to buy a house in 2 years, 3 years, 10 years? What's your horizon? So if it's for retirement, yeah, gold might be a good thing. Remember we talked about inflation. Gold is a good protector for inflation. We'll talk about that. So yeah, having some gold in your retirement plan makes a lot of sense. But she wanted me to tell her whether she should buy gold or not without me knowing why she was investing. And I can't answer that question. So the why is an important question. That's a good place to start before you go any further. Once you have the why, then the second question, I'm on class notes page 4, the second question is what? And this is the bulk of exam 1. This is about 90% of exam 1. Here we're going to talk about asset allocation. What assets can you buy? There's another way, if you, especially in an interview, you want to sound really fancy and really know what you're talking about. We talk about this as beta risk. Your beta risk is which asset classes are you in? Are you in stocks? Are you in U.S. stocks? Are you in European stocks? Are you in Asian stocks? Are you in bonds? Are you in real estate? That's your beta risk. The word beta, you've probably heard that term. It came William Sharpe when he developed the capital asset pricing model, which you should have had before in a previous class. You heard the term beta. Beta here is a little bit different concept, but it derives from William Sharpe's work. and just asking that high level, which markets are you exposed to? What can you invest in? And so we're going to talk about asset classes. What assets can you get into? So asset classes, I'll give you a couple examples of them. U.S. stocks would be an asset class. U.S. bonds would be an asset class. And so how many asset classes should you have? Should you have two? We just say stocks and bonds? Or should you have 5,000? Maybe Apple stock is an asset class. Maybe Walmart stock is an asset class. So maybe there's 5,000, 10,000, 20,000 asset classes. So that seems a little excessive. Two seems like that's not nearly enough. 5,000 seems like it's way too many. Well, what we want to be, and I'll introduce you to this word. I don't know if you use this word very often. See if you can use it in a sentence this next week and impress your friends and see if they know what it means. But parsimonious, it means stingy. You want to be stingy. And so let me explain what that means for asset classes. When you're trying to do an analysis, you have to pick the asset classes you're going to evaluate. And you want to have enough, and this is real key right here, you want to have enough asset classes to explain the risk that you're taking in investing. But you do not want any more than that. Why? Because if 10 asset classes is the right answer, that's what you need, but you add in 15 just to have a few extra. Every extra asset class is a tremendous amount of work. When I was at UTSA, we had what we call a manager search committee. And what the manager search committee did, it was finding portfolio managers for each one of our asset classes. And we would have to interview hundreds of portfolio managers. We would interview several hundred every year. If we added a new asset class, let's say we added U.S. small company stocks, value stocks. So we put all those all together. So that's an asset class. And we've never done that before. Now we have to go out and interview 50 to 100 managers that are in that asset class to try to find which ones we want to hire. That's a lot of work. We may have to hire consultants to help us find managers. It's just a tremendous amount of work. And so we don't want to have 15 if 10 is enough. But if 10 tells us a lot more about risk than 7, then we'd rather have 10 than 7. So there's a very famous article on this written by William Sharpe. Hopefully you've heard of William Sharpe. Make sure you know who he is. He's known as the father of modern finance, not only because of the capital asset pricing model, which is very, very, very important and got us using this term beta a lot, but he's also very well known for getting finance into computers, the use of computers in finance back in the 70s. That was his big thing, and he had a big drive to that. He's also pretty famous for really driving the index fund market. So there's a lot of things he's done. He came to San Antonio and spoke here several years ago, and my boss's boss, the corporate treasurer at UTSA, actually asked him a question at the end of his lecture, and he asked William Sharpe, "What are you working on now?" And William Sharpe said, the math of finance has gotten over my head. It's gotten too complicated, and so he was working on much smaller projects. It's a little scary when William Sharpe, a Nobel Prize winner in economics, a pretty advanced mathematician himself, says the math of finance is over his head. You know that finance is getting pretty quantitative. But he wrote this paper. It's a paper on style analysis. A great concept. We will not do style analysis in this class. I'll introduce it to you here. If you take my risk management class, we do a style analysis there. And in fact, there's a couple of you in this class, in this investment class, who took a risk management class first, which is kind of backwards because it's a little bit more complicated quantitative class. But they did a style analysis in that class. So you might talk to them about that if you want to be interested if you're interested in the risk management class. I think it's really powerful to do a style analysis before you graduate, because there's a high probability you'll actually see something like this in your first job. You might not do the style analysis itself. You might use a software package that does it, but doing one from scratch really helps you to understand exactly what the computer software is doing. So what is a style analysis? What you're doing is you're trying to understand the risk that's in your portfolio by matching it against multiple asset classes. And what you're trying to do is get the highest R squared you can. That way you can see that your asset classes are explaining the risk. The higher your R squared, the more these asset classes are explaining the risk of your portfolio. So R squared is the percentage of the volatility of A, which might be your portfolio, that can explain the volatility of B. B might be a portfolio made up of a collection of assets of your asset classes. And here's the formula in Excel how to actually do it. So I want to go to this article from William Sharp and show it to you. Before I do that, we're about 20 minutes or so in, so this would be a great time to hit pause on this video. Go get some water, stretch, get something to eat, get something to drink. Maybe think back through the class notes, what we've talked about so far. And when you come back to the break, we will walk a little bit through this article. I won't go through the entire article, but I want you to understand conceptually styled analysis, because it's a really powerful thing to know, especially for an undergraduate finance major, because very few undergraduate students actually understand style analysis. So hit pause, and I'll be back in just a couple of seconds here. Okay, so here's the article. It's called Asset Allocation, Management Style and Performance Measurement. It's written in 1992, so it's kind of an old article by William Sharp from the Journal of Portfolio Management, a fairly well-known journal, although very complex. They have some articles that are pretty tough to read. This was one of the easier ones to read. I read this in one of my first jobs. I was working on the trust side of USAA, and I read this and I thought, wow, this is really pretty cool stuff. I thought it was pretty exciting. And I started doing it at USAA immediately. I started doing style analysis at USAA. My bosses had never heard of it, and I thought it was really powerful. I didn't do it exactly the way William Sharp did, because I don't quite have, I don't remember all the math skills of my calculus to be able to do it. But Excel allows you to do it. You can use an Excel solver and do everything in Excel without having to do all the formulas that William Sharp shows you. But let's look at this article. We won't go through all of it, just real quickly. He's trying to create a factor model. What a factor model is, you have certain factors by different asset classes. You want to put them together so you can find the optimal portfolio for your client. And what you're trying to do is find the return. That's what the R here is. The return is these weights on these different factors, and at the very end you have an error term. And so what he's trying to do is minimize that error term by getting the highest R squared he can. And so you can see the formula for R squared. There's the formula for R squared. You can calculate that in Excel. So what he's trying to do is be parsimonious. You can see that in right here. It's the only time he uses the word. This is the first time I ever heard of this word, so I had to go look it up. Be stingy. So we want to have a high R squared, but we don't need it to be 99.9999. You know, there's good enough, because remember all the extra work of adding other asset classes. And R squared will tell you, the higher the R squared is, the more explanatory power you have. And there comes a point where your R squared is high enough, it's good enough. And so his model, you can see his 12 asset classes here. And these are interesting. Our list will be slightly different than his, but he starts off with bills. What he means by that is treasury bills, which essentially what he means is cash. Cash will be one of our asset classes. Then he talks about different bonds: government bonds, corporate bonds, and mortgage-related bonds. He talks intermediate and long-term. We'll definitely use those terms. We'll definitely talk about these different types of bonds. We'll spend some time talking about mortgage-related and government and corporate. So we'll use some of those. On the stock side, he has large company stocks, medium company stocks, small company stocks. On the large company stocks, he breaks them between value and growth. We'll also be doing this capitalization and this value and growth. We're going to add one extra feature, which is beta. We'll add beta on top of that. He doesn't have beta in here, but we'll use some of these classes here. Then he has non-U.S. bonds. We're going to talk non-U.S. bonds, but I'm actually going to classify it as an alternative. Is not really an asset class the way he does, and I'll explain why I don't like non-U.S. bonds as one of the asset classes. And then this is where he's the most different from what we're going to do. He does his international stocks are European stocks and Japanese stocks. Now, why would he break out Japan separately? Well, at the time he did this, Japan was massive. Their stock market had really soared since the 70s. Japan was really an incredible story economically. their stock market was more than half of the world stock market except for the US. If you take the US out, you look at the world stock market, Japan was one half of that market. Well, today Japan sold off dramatically after in the early 90s, and it dropped like 85, 90%. So today Japan's stock market not nearly as large. So today when we're looking at European, Japanese stocks, we're going to be looking at developed market stocks, emerging market stocks. We're going to break it up a little bit differently. But he's using a similar approach. I wish he would update this paper to today, because I'm sure he would get very different answers today. What's important. So there's just one last section I want to show you. Come down to Table 2. And I think this will help you understand style analysis. So what he's doing, he's just got a mutual fund. We will talk about mutual funds in our class when we get to the second section of the class. This is the mutual fund. It's called Trustees Commingled Fund. And we'll talk about commingled funds as well. So this is probably a commingled fund, not a mutual fund, but they're very similar. And he wants to figure out what risk this fund is taking. What markets is it exposed to? He ran his analysis 3 times. He did an unconstrained regression, a constrained regression, and then another constrained regression. And the first regression he ran, he got an R-squared of 95%, which means with this allocation, he could explain 95% of the volatility of this fund, or 95% of the risk of this fund. Now the problem with this unconstrained, there's 2 problems with it. First of all, it only adds up to 73%. Where's the other 27% of the portfolio? Did it just disappear? That doesn't make sense. So that's kind of bizarre. So he fixed that in his first constrained regression. He said it has to add up to 100%. You notice this R-squared hardly budged. We're from 95.2 to 95.16. So this makes sense. You want to make sure you account for your entire portfolio. But the problem here, you can see that he's shorting, or he's selling short in intermediate term bonds. And he's shorting medium stocks, US stocks. Well, your portfolio may not be able to do these negative numbers. That may not be possible for you. Some portfolios can, but a lot of portfolios cannot do that. And so he did one last constraint, add up to 100%, and no negative allocations. And when he did that, he got an R-squared of 92%. So it dropped. It wasn't as good as the 95, but still pretty good. So what is this fund manager doing, this trustee commingled fund? What is it doing? Well, it's 70% U.S. large value stocks and 30% U.S. small company stocks. Now, he did not break small company stocks between value and growth. My guess is that he had done that. We probably would have found this to be 70% large company value stocks and 30% small company value stocks. This is probably a value portfolio. We'll talk about what that means, so don't worry about if you don't know what a value stock is. We'll talk about it later. But this is what style analysis is, and I started doing this at UTSA. I would collect data on all of these asset classes. I would then have Excel solver change the allocation to the different asset classes and match it up against the monthly returns of my portfolio to get the highest R-squared I could, so I could see what risk are we taking in this. And I'll show you as we look at a few funds and talk a few funds, you'll see, especially if you use Yahoo Finance. Yahoo Finance shows style analysis very much in this kind of a framework, and so it's a powerful tool to have. All right, so if we flip back to the PowerPoint, so there's the what question. Getting a little bit more into that, let me give you an example of this idea of parsimonious. So let's say your boss gave you 5 asset classes, and your boss says, she goes, okay, if we had just those 5 asset classes, that would be really good because it wouldn't be much work. We'd only have to hire managers for 5 assets. We'd only have to monitor 5 asset classes. Take those 5 asset classes, pit them up against our portfolio, and see how much of our risk you can explain. And you come back to her and say, we can only explain 70%. 30% of the risk we're taking are not covered by those 5 asset classes. Says, well, that's not good. And so you add 5 more asset classes, you run it again. This time, wow, you do great. You get an R-squared of 98%. Say, wow, I'm really explaining the risk of this portfolio. That's really good. Then your boss says, well, You know, I heard about this thing. It's this asset class called non-U.S. bonds in emerging countries. And I also heard these real estate value companies or whatever, you know, other asset classes. She gives you 5 more. And so you run those, and your R squared improves. It always will improve, or it can't get worse. So it goes up to 98.1. So it is better, but boy, it's not much better, and you sure don't want to do the work of having to find managers for those 5 asset classes. So you come back to your boss and say, you know what? 10 is parsimonious. That's the best answer. It's stingy. It does a great job of explaining a risk, but it's a lot better than 15. 15 only slightly better explains the risk, but it's a lot less work than doing 15. So in fact, you know, it's a third less risk. So let's stick with that. Now maybe 9 is the right answer or 11 is the right answer. We didn't run other. It's unlikely more than 10 would be necessary because 98 is really, really good. So that's the key, is be parsimonious. The key to parsimonious is your assets have some uniqueness related either to the returns. Some assets have low expected returns. Some assets have high expected returns. Their volatility or their standard deviation, their risk. Some assets are low risk, some are high risk. Or their correlation. There's some assets that are really good at diversifying the portfolios and others aren't. And you know, diversification, that's measured by correlation. And that ranges from -1 to +1. So if you have a negative correlation, it means it's helping diversify your portfolio. So cash, we'll talk about cash. Cash has a low expected return, but very low risk, but also has good diversification benefits. Cash tends to do very well when markets are selling off and crashing. Stocks have a high expected return, but also have high risk, and they're not good for diversification. When the stock market's crashing, that tends because there's some crisis, and so everything else is probably crashing as well. So they don't give you good diversification, but they do give you good high expected returns. Now gold has a very low expected return. It's very, very volatile. So why in the world would you ever buy gold? Well, because gold is a tremendous diversification. Gold does really well in a crisis. We saw during COVID-19, gold has been doing really well through the summer of 2020 and through COVID-19. Gold is getting really close to a new record, may hit a new record by the time you watch this video. So that's where parsimony comes from. Your asset class adds something unique in those 3 categories. All right, so we're going to spend a lot more time on the what as we get into these asset classes. It's the bulk of the first part of the class. To me, it's the most exciting because I really love talking about these asset classes. It gives you some power. I think, you know, Thanksgiving when you talk to your uncle and he finds out you're taking this class, you're going to get some questions. He's going to ask you some questions. You will be able to impress him, even if he has a little bit of an investment background. Boy, I think you'll impress him with some of these answers, especially when we talk some of the fixed income items. All right, so the third question is the how. How are you going to execute this? You know why you're investing, so you got your liability defined. You know your horizon. You know what you can invest in. You have your asset classes defined, and they're laid out. So now you're ready to invest. So on pages 4 and 5 of the class notes, how are you going to execute this strategy? So again, 3 questions. You have 3 questions. I like having 3 questions. It's a short enough list to be able to keep track of, and you're trying to put this into your permanent memory. So the 3 questions. The first is, what is your strategic allocation? Strategic allocation is also known as your policy portfolio. That is, where are you normally going to have your investments? So is it 60% stocks, 40% bonds? Now what is that strategic allocation? So we'll talk some of that. We'll give an example of that later in class when we do the tactical allocation exercise. The second question you ask is, are you going to do this yourself? Are you going to hire a professional manager to do this? If you do it yourself, you're going to be doing what's called security selection. You are going to pick which stocks and which bonds you want in your portfolio. You'll decide whether you want Google or Facebook or Tesla or Apple. If you hire a manager, you will outsource that, and you will hire a mutual fund or an exchange-traded fund or somebody, and they'll make the decisions about which stocks and bonds to buy. So you have security selection or manager selection. And then the last thing you're going to do is ask, will there be tactical bets? Are you going to be active? So tactical bets can come in two ways. One, it can be against your allocation. So maybe you normally have 60% in stocks, and that's your policy portfolio, but maybe your policy says, but you can take tactical bets, so you can reduce your stocks all the way down to 40% and maybe as high as 80%. And that could be an active bet that you make. You're being active in your portfolio. The other one is on the actual securities that you buy. So you might be active on, I want to buy Apple instead of Google. That would be an active bet. So you can be active on asset classes, you can be active on securities, you can be passive on one, active on the others. So you can be passive on your asset allocation. You say, hey, we're always 60% in stocks, but when we buy stocks, we can make a decision about which stocks we want to buy, Apple or Walmart. We won't just buy what the market gives us. Or you can be active on the asset allocation, but passive on the security selection and just buy the market. That's what passive means. You may have heard of index funds. We'll talk about index funds. They just buy the market. If Apple is 3% of the stock market, then they have 3% in Apple, and they don't take a bet. So you can kind of mix and match all of these into different groups, but that's a decision. These are decisions you have to make, and it's not all or nothing. So you could be active on U.S. small company stocks, but passive on U.S. large company stocks. So it just depends. I've seen it all different ways, and I've done it all different ways. And it just depends on the confidence you have in your abilities when you want to be active and passive. We'll talk more about this and the advantages of being passive versus active, because it's a lot cheaper, a lot less expensive way to invest. So the execution is, what do you actually buy? Do you buy stocks, mutual funds? Whom do you hire? Do you do it yourself or hire a portfolio manager? And it includes the decision of active versus passive. And active is when you're trying to beat the market. You're going to do something different than your strategic portfolio and different than what those asset classes are doing. And you're going to, what we're going to say, overweight. If you're active, you're overweight or underweight. We're going to have an exercise, a really great exercise. I really love doing it. I'm excited to get to it. I'm going to do my best to help everyone get through it. It's the one question on exam one where some students do really well on it and some students do really poorly on it, and I'm trying to get this semester, whatever it's going to take, so we can get most, if not all, of the class doing well on it. I usually have 20% that do really, really well on it, a good chunk in the middle, 60% or so, 50% that do okay on it, and then there's usually a group that 20, 30% really struggle on this question. I want you to do well on this question because it's a powerful question. If you understand this question when we get to it, and you'll see when we get to it, I'll give you plenty of examples to practice and get better at it. If you can get good at this question, you are ready for your interviews. You're ready for the investment world. All right, so just summarizing up that how question, you have a strategic allocation or a tactical allocation. Strategic is your portfolio, policy portfolio. What does your investment policy say you normally do? It's kind of what you would do if you had to invest and go away for 40 years and not touch your portfolio 40 years. You would just stick your portfolio there and just let it ride and not worry about it. There's a famous study. I wouldn't read this during the semester, but it's something you might want to read after semester. It's very, very famous. Any of you that are interviewing with financial planning jobs, financial planners reference the Brinson study all the time. They usually reference it incorrectly. It's one of the most misquoted studies out there. But essentially, the Brinson study is talking about how important that strategic allocation, that policy portfolio is to the risk of your portfolio. Your tactical bets usually don't change the risk of your portfolio much. What it does is influences the return. And that's where financial planners get it wrong. They say Brinson talked about how important strategic allocation is to the return of your portfolio, but they did not say that. They talked about how important your strategic allocation is to the risk of your portfolio. It's the tactical bets that help determine the return of your portfolio. So that's the how question. We'll get into that. I'm really excited about it, so just kind of get excited for us to get to that. Before we do that, though, we've got to get through the asset classes. So let's talk the major asset classes. So I'm on page 5. So let's talk about how we're going to do this. You got the 3 questions. Why are you investing? In what can you invest? And how will you execute? We're not going to come back to the why question again. I spent a lot of time on that in my life insurance class, in my risk management class. But right now what we're going to do is really focus in on the what question. And what can you invest? And that's those asset classes. We're going to spend several classes on this. I'm going to give you some powerful tools that you can really become a really good investor, but also answer questions in an interview in an incredibly detailed and a perspective very few undergraduate students have. So I hope I'm going to give you some great arsenal here. And then the last question, the how, we'll do that after the exam 1. So we'll get to that later in the class. We'll spend quite a bit of time on that as well. But this is the what question. It's my favorite part of this class, is getting to this. So there's 4 major asset classes, and we're going to take these major asset classes. Today we'll introduce the major asset classes, and in the next several classes we'll be breaking these major classes into subclasses. So the first class is cash and cash equivalents. The second major asset class is bonds, also known as fixed income. The third, it's called stocks. Some people do call them equities. I explain why I do not like the term equities here in a little bit. And the last category we call alternatives. All right, so there's our 4 asset classes. The first 2 asset classes, I have them here on the same page. They're actually the same asset class, because in both of these, what you're doing is, if you look down here under A, they're both involved lending money to somebody else. So what's the difference between cash and bonds? If we're just lending money, the difference has to do with these 2 risks: reinvestment risk and price risk. So reinvestment risk is the risk that while you're investing, you have a bond mature. Say you have a $100,000 CD and a certificate of deposit. It matures, and now you have $100,000, but interest rates fell dramatically the last few weeks, and now you're ready to reinvest, and this bond that matured that was paying you 5%, now it's matured, and now you have $100,000, and you can only reinvest at 1%. Boy, your income just dropped 80%. That's pretty terrible. That's reinvestment risk. Cash has very, very, very high reinvestment risk. Cash just moves up and down with interest rates. When interest rates fall, what you make on your cash investments falls. So your savings account at a bank, that's a cash account. It's probably making you 0.1% now, if even that. So cash has very low reinvestment risk. Bonds and fixed income have varying degrees of reinvestment risk. It really depends on how long the maturity is, or we're going to use the term duration. We'll talk more about duration here pretty quickly in the next few classes. But bonds with low duration, cash has the lowest duration. They have very high reinvestment risk. Bonds with higher duration have much less reinvestment risk. The second risk is price risk, also known as interest rate risk. I talk about this quite a bit in my risk management class. So price risk is the risk that interest rates will rise and bond prices will fall. Bonds and interest rates usually go in opposite directions, so that's price risk. So cash has almost no price risk. When interest rates rise and fall, the price of cash, your savings account, if you have $1,000 in your bank savings account, it's always $1,000. It doesn't matter what interest rates do. But if you buy a 30-year Treasury bond and interest rates rise, that bond could probably drop in value 30% easily. They're very volatile. So the more duration a bond has, the less reinvestment risk it has, but the higher price risk that it has. So bonds have varying degrees of price risk, but less reinvestment risk, but also varying degrees. I like this term, varying degrees of price risk, varying degrees of reinvestment risk, related to the duration. So 30 years, 0 coupon bond, so it doesn't pay any interest. So you pay $100 for it today, and in 30 years it matures at $1,000, and there's no coupons, no interest at all. That's going to have extremely high price risk, but very little or no reinvestment risk, because there's nothing to reinvest for 30 years. All right, so the most common approach to balance these 2 risks, you can see they go in opposite directions, is something called laddering. And you can actually type that in, laddering certificates of deposits. What you want to do is make sure you have something maturing evenly throughout your investment horizon. So if interest rates fall, you have some bonds that still haven't matured and have the higher interest rate. So that protects you from reinvestment risk. But if interest rates rise, you have some bonds maturing, and you can reinvest at the higher interest rate, and you can reduce some of your price risk. There's some great books on fixed income. This first one's by a gentleman named Frank Fobazzi. I don't think he actually wrote it, but he's the editor of it. He probably wrote sections of it. Very long book, probably 1,300 pages. I highly recommend getting the book. You can get an older edition and save some money. It's not a book that you would just read straight through, but it is a book that's great to have for reference. The second book, I won't go into them here and show you. You can look them up yourself. It's a book by Bruce Tuckman. It is a more readable book. It's less than half as long as the Fabozzi book. He doesn't go quite as in detail as Fabozzi. He doesn't have the quantitative and not quite as complex, but he does spend a lot of time talking about these strategies: laddering, bullet, barbell. He does a much better job talking about that. How should you position your portfolio? So they're both very, very good books. All right, so we just have one last slide here to go through. I recommend right now, hit pause, go get something to drink, get something to eat, and we'll finish up the last two asset classes. So I'll give you a couple of seconds so you can hit pause, and I'll be right back. All right, so the last two major asset classes, stocks and alternatives. So why don't I like to use the word equities for stocks? So when I retired from UTSA, I was vice president of equities. That sounds cool. For some reason, it sounds a lot better than vice president of stocks. But equities just means you have ownership, that you're an owner. So if you own Apple stock, you're actually an owner of the corporation Apple. You might be a 0.00001% owner. You only have a few shares, but you are an owner of the company. But ownership can also apply to other assets like real estate. You can own real estate. You can have equity real estate, which just means you're an owner of the real estate. So equity applies to stocks and many other things. So bonds, you do not have equity in bonds. In bonds, you're loaning someone money. You're not actually investing in them. You don't have ownership interests. You're simply loaning them money. They've got to pay you back. But with stocks, real estate, and other assets, you have actual ownership. Those are equities. So stocks, I'll be using the word stocks versus equities mostly in this class, but some people do use equities as a substitute for stocks. We will look at the sub-asset classes on equities, and we'll get into them. We've talked about a few of them already. We talked about capitalization, large companies and small companies. We talked about style, which is value versus growth. I talked a little bit about U.S. versus the non-U.S. There we'll get into developed versus emerging and frontier. The one I haven't talked about yet is beta, cyclical versus defensive stocks. That's the one that William Sharp did not have on his list. So I'll walk through these. You can see there's all different combinations you can do. So you can quickly get up to 30, 40, 50 asset classes. We'll see how many we use in our group. When I was at UTSA, we had 26 asset classes, but really it was 13. But I had two entities I was dealing with they were taxed very differently. So I had 13 asset classes for one entity and 13 for the others, so that I had different assumptions related to the tax side. But you can see you could easily get up to 50, 60, 70 asset classes just by doing all the different combinations. And then the last group of assets we call alternatives. And very important when you explain alternatives that there's two reasons people like to do alternatives. The main reason is the diversification benefit. Alternatives like real estate, commodities, they tend to be uncorrelated to stocks and bonds in the U.S. And because of that, they help diversify your portfolio and reduce the risk of your portfolio. So that's a really good thing. They have low correlation is the way we say it, essentially. So that's a good thing. So that's the diversification benefit. The second thing, which is somewhat related to it, is a lot of times alternatives give you protection from inflation. Commodities and real estate, real assets, that's what these are. We'll talk about real assets. They give you protection. So in the 1970s, we had high inflation. Both stocks and bonds sold off quite dramatically. Neither did very well. But real estate and commodities, especially oil prices, energy, did really well in the 70s. So that helps you. I'll talk a little bit more about stocks and bonds. Sometimes stocks and bonds move in the same direction when there's high inflation. Sometimes they move in different directions, like we've seen here recently. So we'll talk about that. But yeah, real estate, commodities, they're good benefit for inflation. Now there's other alternatives out there. Emerging market bonds. Some people will actually have emerging market bonds under fixed income, under bonds. I'll discuss in class why I do not like emerging market bonds under bonds. I like to have them as a derivative. Some asset classes, like on stocks, you notice on stocks I have emerging stocks, emerging countries here under stocks. When I finished college, emerging market stocks were actually part of alternatives. They were not part of stocks because people thought investing in countries like South Africa or Brazil, or China maybe, or India, those were very new markets, very immature markets. Very dangerous. People consider that to be an alternative. Well, today, emerging market stocks are very common. Many people invest in them. There's billions of dollars in them throughout the U.S. So today, emerging market stocks are part of stocks. So what happens with alternatives is they may start as an alternative, but they then may eventually move to another asset class or become their own asset class. So at UTSA, we had cash, we had fixed income, we had stocks. We also broke out real estate as a separate asset class. And we broke out private equity and venture capital. And we'll talk more about private equity and venture capital. All of these we're going to get into more detail on. That was a separate asset class. So those were our asset classes. We didn't do some of these other asset classes like coins or artwork or those kind of things. We didn't get in those areas. We didn't really do much in commodities when I was there. So it depends on the firm. So there's different combinations. I'm giving you a very conventional approach, but as I go, I'll try to tell you other ways of thinking about it so that in an interview you can step out and sound a little more sophisticated than the typical undergraduate student on this. So there's your 4 asset classes. What we're going to do next is we're going to go back to each one of them and talk through them in detail. Looking for sub-asset classes. So the key is understanding the sub-asset classes in terms of defining it and then essentially given the categories. We're going to see the subcategories, and you'll see this real quickly when we get into bonds and talk about duration. And then the strategy. What strategy would you have? So you'll see this real quickly. The nice thing about this is we go through this, so keep this in mind. I want you to always forefront in your mind as we go through each asset class. Define it, talk about the subcategories, and then talk about the strategy. If you do that and you learn it well, we have 2 questions on the first exam, but you won't have to study for 2 questions. You only have to study for 1. For everything we're doing in this part of the class, we'll answer both of those questions. So I'll give you a great arsenal for understanding really how to put together a portfolio. So I'm really excited about this part of the class. I strongly encourage you, now that you've seen this, go back with a blank piece, maybe look through your notes, read through it, and then go back with a blank piece of paper and see if you can write all of this out, what we just done. And then go back and see what you missed. So what's an investment portfolio? Do you remember the definition of that? An asset, a collection of assets held for a future purpose. What are the 3 questions you ask? Well, why are you investing? Understanding that with the concept horizon and liability driven. The second question, in what can you invest? So those are asset classes. What's this idea of parsimonious? What does that mean? And then the third thing is how. How are you going to execute this? Those 3 questions. What is your strategic allocation? Are you going to do it yourself or hire a manager? Are you going to be tactical? Are you going to be active? Are you going to be passive? And then what are the major asset classes? Cash and cash equivalents, bonds or fixed income, stocks, also known as equities, and alternatives. And then how do you distinguish between cash and bonds? So you can see the outline here, the outline for the exam, but even more so the outline so that you can hit the ground running in your interviews and in your first job in finance. So I'll stop it there. It gives you a lot to work on. Very much take advantage of this class to go over this material a few times so it starts sinking in.